Hello, my name is Randall Liss, and I'm here to talk about options with you. Today I want to discuss an interesting strategy. It has its risk, but it often pays off very, very well. It is a 1-by-2 ratio spread, where you're long 1 at the money, short 2 out of the monies, and we're looking to do it for a credit. We're going to use an example now using calls in a hypothetical stock. If I used a real stock, this talk would have a short shelf life of only today. So I'm going to use a hypothetical stock because I'm teaching you how to look at options, how to think about options. So we have the stock XYZ. It's trading at 100. We're bullish on the stock. We think the stock can go higher. We think the stock can go to 110. So what do? We buy the 100 call one time at 11. Hypothetical prices. We buy the 100 call one time at 11. We sell the 110 call at 6 two times. This is our hypothetical trade. We're long the 100 call once at 11. We're short the 110 call twice at 6. That means we've paid 11. We've taken in 12. We have done it for a 1-point credit. Now, I said this is a bullish trade, and it is to a certain extent. But it also has sound downside protection. Because think about it. If the stock goes below 100 or on expiration, both of these options are worthless, but you collect that $1 credit. So any move below 100 makes you $1. Where do you make the most money? You make the most money when your long 100 call is worth the most it can be, while at the same time having your short 110 calls go out worthless. That would be, yes, 110. At 110 exactly, on expiration, the 100 call you paid 11 for is now worth 10, so you lose $1. But the two 110 calls you sold at 6 go out worthless, so you collect $12, giving you a best case scenario of an $11 profit if you were right, and we go right to your target price of 110. So you are net option short. That means at a certain point you will lose money. And also, where is your break even? Always important to know. Where do you think the break even point is? I will give you a hint. Your $11 maximum profit has something to do with it. Any ideas? Okay, we'll jump to the chase. At 121, you break even. Let's work it out. The 100 call, you bought at 11, is worth 21. You make 10. But the 110 call, you sold at 6, is worth 11. So you lose 5 twice. Also 10, that's a wash. So above 121, you start to lose money. But look at that. That's a good ways to do it. So if your vision is the stock is going to move there slowly, incrementally to my higher level, a 1-by-2 ratio call spread is a very good trade to do. But it does bear watching. Another piece of warning advice. Don't do this trade in a stock that is a takeover candidate. Don't do this trade in a stock where there's any chance at all that we gap open at 130 without you being able to do anything about it. This is a strategy for normal blue chip stocks that you think are going to gradually go higher. It has risk because you are net short options, but the clock is on your side and it gives you a good break-even point. Once again, the break-even point is the next equidistant strike higher plus whatever credit you received, in this case, 121. Now, perhaps you have questions about the strategy I outlined. Then I suggest you go to my website, www.thelistreport.com. I'm available. You can ask me any question you like. You can also read what I write about options and the market every day. My name is Randall Liss. Thank you for your attention.